We have with us the management of Satin Creditcare. This is on the back of their fourth quarter business update, which came last week. The company's assets under management have crossed 10,000 crore. That said, the disbursals were a bit weak, just up 0.8% on a quarter-on-quarter basis, and the collection efficiency declined in the quarter. We're now joined by the Chairman, Managing Director of Satin Creditcare to take some questions. Morning, this is Rima here. First, are you seeing any signs of pressure in the MFI and rural area? Any early signs of that? And two, while your disbursal growth is up 0.8% on a quarter-on-quarter basis, your AUM growth is up 8%. So can you explain that? Is it that the tenor of the loans has increased?
So I think if you look at the thought that which have right now is that there is absolutely no stress in the rural system as such. If you take a cue from that, I think for us the basic figure to really look at is what the credit cost has been. Not to be too dependent on what the collection efficiency would have been. Collection efficiency is an effect of technically various other states working on the collection efficiency mechanism. But ultimately, what's the credit cost? And I think we are pretty much under the guidance which we had given earlier of our credit cost. So typically, if you really look at, I think we've been very good on the asset quality front. In terms of disbursements, again, for us, quarter-on-quarter is not what we really look at. I think we had given a guidance of about 25% plus. We've done, in fact, 34% in terms of our YOY AUM. I think that is the more relevant figure to probably really look at, rather than looking at the quarter-on-quarter figures. So I think we've been able to achieve a 25% plus growth, which is about 34%, and I think that is what speaks of how the growth momentum has really taken shape.
So the credit cost, which you're saying is the important metric to track, what was the number in Q4? I remember your guidance was to keep it below 1.5%. So what was the number in Q4 and going ahead, FY25?
So for us, the guidance, we are under the guidance, so I think I probably will not be able to give you the exact numbers right now because it's still under audit, but definitely yes, credit cost is under the guidance which we have already given. And going further ahead for the next year also, we had fairly given a guidance of about 1.5% to about 1.75%, and we are very, very sure and optimistic about it that I think the credit cost will hold on within that band, which we had given earlier.
Mr. Singh, good morning. Thanks a lot for joining in. What about growth on disbursements, AUMs? AUM growth this time was 34%. For the full year, disbursements were up close to 30%. Do you stick to that sort of a guidance in FY25 as well? Would you be able to achieve these kind of numbers?
So absolutely. I think we've given a guidance again of 25% plus, for the next year. And I think we are very well sure that we'll be able to achieve that guidance, in terms of disbursements as well as the AUM. Will be there.
What was your cost of fund in Q4 and also the incremental cost of fund? And how would it compare with the average?
So cost of funds is definitely, again, a correlation of the availability as well as your ratings and everything put together. We've had a rating upgrade pretty recently. And what we are seeing now, that for us, our cost of funds are also now going down, though very slightly as such. And I think that momentum will hold in the next year when we have a full-blown for the whole year as such, to probably be there. Our upgrade happened sometime in December, January. So I think that period was that window was pretty small in terms of the cost of funds to go down. But we are hoping that the cost of funds now for the whole year will probably go down.
So what was the incremental cost of fund? Is there a number, sir? And how much do you think it will decline in FY25 given the upgrade?
See, I can hazard a guess, our cost of funds is close to about 11.5%. My own sense is at least we can see a 25 basis point, going down from there. That's the bare minimum which we're trying to look at. But hopefully we'll be able to do much better than that.
Mr. Singh, what about asset quality? There was some deterioration in some of the lenders seen in the December quarter, including your own book, if I'm not wrong. I may not ask you for a specific number, but is there an outlook that you can share going into FY25? Do you see an improvement on that front?
So asset quality, as I said, my credit cost is under the limits, the guidance which we had given, and the same limits continue for the next year. So there is no stress in the asset quality per se as such, both for the year which is gone by as well as for the corresponding new year which is going to come.
But with elections coming up, Mr. Singh, do you foresee any unforeseen pressures on the asset quality with the elections coming up, potentially a new government being voted into power, some decisions taken on loan waivers, etc., etc.? Are you preparing for something like that?
No, I don't think so. No. So what has happened, the first phase is coming up in the next 10 days or so. So we've not seen any kind of a pressure in terms of the thoughts about loan waivers or anything which is putting pressure on the collection efficiency. There's holding stable right now. And that's the reason why I said, including the election period time, which is now probably going to take at least about 2 months. We're already, waiting for the first phase to come in the next 10 days. We are seeing nothing on the ground which would affect the credit cost or the asset quality.
And typically during this election period of 3 to 4 months, does lending slow down? In just what do you expect just in the near term in terms of lending?
See, the first quarter is always very slow because that's the beginning of the first quarter. You're just waiting for the results to come in, for the whole year results to probably come in by April end. So typically the first quarter is pretty slow, but we are still seeing a very strong momentum in the field. And that. Seeing that, I think, for us, we are looking at that as compared to the earlier years. We feel that, this particular first quarter will also be not that slow as used to be there earlier. Basically, that's the only, thought I can leave you with,
Can FY25 growth be better than FY24 growth of 34%? Considering things are picking up on the ground, Q1 you're saying should not be, should be better than what Q1 typically is.
Don't tell me to commit any numbers as such, but I said,
not committing. I'm just asking you better. Do you think it'll be better or same?
I said it's going to be positive. That's for sure. That's for sure.
It's going to be positive. So, Mr. Singh, but what is your borrowing mix currently? What is the proportion that you are borrowing from banks?
So for us, banks constitute about 50 to 55% of our borrowing. We have a lot of foreign funds, in terms of ECBs and DFIs who are there. Public market is pretty small, for us. But I think that the major share is with the PSU banks as well as private banks, but they constitute about 55% of us, The balance comes from a mix of NBFC, which is also a very small component of the entire mix. But there's a lot which is coming in from, in terms of ECBs, NCDs, from foreign DFIs, which are there as our lenders,
Just one final question. What will be driving the NIM movement for you, net interest margin movement for you next year? What would be the key factors?
So NIM would be, if you really look at it, I think asset quality probably, so we don't have too many overdues. I think, that will probably also add up to this. I think, for us, the growth in terms of the disbursals will definitely be there. The other thing which probably we are looking at, and that is we're trying to look at how we are able to contain our opex, and that is probably one of the key factors which is probably going to play out for the next year, and we're definitely trying to look at so that we're able to have maximum optimum efficiency in terms of our operations and try and see if we can probably bring our opex down from wherever it is right now.
How much leverage do you have? How much of a lever can opex be, bringing down those costs? Where does it stand at? What's the ideal number that you'd like?
See, it used to be, around 6% earlier, and it came down to about 5.7, during the December quarter. I think, for us, the lever, which probably, again, extends to optimum efficiency in terms of the number of borrowers per loan officer, as well as the other matrix which is there. I think, my sense is we still have room to play with another 30 basis point, for it to probably go down, But that's spread across the whole year as such, So I think, we are looking at the opex, maybe in a far more deeper fashion than we used to do practically before this.
All right, Mr. Singh, we'll leave it at that. Thank you so much for joining us this morning and sharing your updates for the quarter gone by and for FY25. We wish you good luck for the new financial year. Time